The wealthiest retirees can spend millions without paying federal income tax. It's totally legal and more accessible than you think, maybe even accessible to you. We'll talk about that next on Holy Schmidt.
Holy Schmidt!
Picture a company founder who started their business 30 years ago, and at the time, the shares were pennies on the dollar. Today, those same shares are worth over $50 million, and if the founder sells even a small percentage of them, they're going to have a massive capital gains tax bill. So to avoid paying all of that tax, they do something else instead. It's something that most retirees, almost all retirees in fact, have never heard of. It's called the buy, borrow, die strategy. According to a 2025 study from the Yale Budget Lab, it is the main reason, or one of the main reasons anyway, why the wealthiest of the wealthy in this country pay almost no income tax. Now, to be really clear, I'm going to show you how it's done, but for a lot of you, maybe even for most of you, this isn't the right tax strategy for you. Still, with knowledge comes power, and you may find parts of this quite useful. All right, let's jump into it. The strategy itself sits on three relatively ordinary aspects of the tax code, and taken by themselves, they aren't really that big of a deal. But like most things in the tax code, when you combine two or three things that weren't really designed to work together, sometimes there's an advantage, and that's what we're going to talk about here. The first is one that almost everybody knows, and that's you only pay capital gains tax when you sell the asset. If you buy 1,000 shares of stock at $50 per share, for example, that's $50,000. If 20 years later, those same shares are worth $500 a share, that's $500,000. That's a $450,000 gain on the asset, an unrealized gain because they haven't been sold yet. And you don't pay tax on unrealized gains. You only pay tax when you sell. The tax code calls this a realization requirement. You need to realize the gain in order to pay taxes on that gain. Rule number 2, again, very ordinary. Borrowed money is not income. If you go and borrow $200,000 to buy a house, the IRS doesn't say that you had $200,000 of income that year. And by the way, this is true for a mortgage, it's true for a car loan, and it's true for a loan backed by securities in your investment portfolio. Rule number 3, when someone passes, the heirs get what's called a step up in basis. Using the example we talked about before, that $50,000 worth of stock that increased to $500,000, if the person passed without selling them, the heirs' basis is $500,000. They don't pay tax on that $450,000 of gain. Under Section 1014 of the IRS code, this applies to most assets. It applies to stocks, real estate, rare art, just about anything that can appreciate in value. They all get reset to fair market value the day that you die. Now, this is a perfect point to talk about what accounts this applies to and what accounts it does not apply to. There are 3 different types of accounts most people have. There's your regular brokerage account that you have at Schwab, Fidelity, Vanguard, whatever the case may be. And when you have interest income or dividend income or capital gains income from that account, you get a 1099 at the end of the year, and you use that to pay taxes on those gains. Call this your tax now account, because the moment you have a tax event, you have to pay taxes on it, interest, dividends, or capital gains. The next type of account is a 401k or an IRA, and this is a tax later account, meaning you pay contributions into the account with tax-deferred money, but when you take it out, that same account taxes you upon the withdrawal. The third account is a tax-never account, and that's a Roth IRA or a Roth 401k. You put money in with after-tax dollars, and then you take all the money out without ever paying taxes on the gains. And the step-up in basis only applies to a brokerage account. It does not apply to a 401k or an IRA. On a previous video, I made a comment about a Roth conversion and paying taxes on the Roth conversion, and we had a few comments from people who thought that if they passed before the funds were withdrawn from the IRA or the 401k, that their heirs did not need to pay taxes on that. That's not true. That only applies to a brokerage account. So the whole strategy depends on the retiree having real wealth in that brokerage account. But a lot of people build their wealth inside a 401k and then roll it into an IRA after they retire. Or they put money into a Roth, or they have Roth conversions along the way. This strategy only works with a brokerage account. And of course, other assets that aren't tax advantaged that you might own, like real estate, or rare art, coin collecting. You get the point. So here's how the wealthy put these three rules together. Instead of selling the assets, they borrow against them. The product they use, at least when we're talking about a brokerage account, is a securities-backed line of credit. Fidelity, Schwab, JP Morgan, Merrill Lynch all have this line of credit available. And here's how it works. You pledge your securities, and that is used to establish your line of credit. And then you borrow on that line of credit. The size of the line of credit depends on the lender and the assets that you have, but some lenders give you 50 up to 70% of the value of your securities in your account. And if you have treasury bonds, it can go as high as 90%. But here is the catch. For most of these, the minimum account size is $100,000, $250,000 at other institutions. So you need to have a meaningful amount of money in your brokerage account in order for this strategy to work for you. The interest on these loans is tied to the Secured Overnight Financing Rate, or SOFR. As of April 2026, SOFR is about 3.6%. Fidelity, as an example, charges somewhere between 1.9% and 3.1% on top of the SOFR rate. So a typical securities-backed line of credit costs somewhere between 5.5% and 6.75% as of April anyway. There's no fixed repayment schedule. There's no maturity date. You can carry the loan indefinitely. You can pay it off in a year. You can pay it off in a month. You can pay it off in 10 years. You can pay it off when your securities continue to appreciate and you sell them. And because loan proceeds aren't income, you don't owe tax on the loan. And in many circumstances, you actually get a tax break from the interest on the loan. To get the tax break, you have to offset it against net investment income, and you have to itemize your taxes. Importantly, ask a CPA before you count on that deduction. Now, all of that's interesting, but this is where this strategy has its bite. When you pass away, the loan gets repaid from the estate funds, and your heirs get a step up in basis, so they don't pay tax on the gain of those securities. The estate turns around and sells them at the new fair market value, and there is no tax due on those proceeds. Here's a simple example. Say you bought a stock portfolio 30 years ago for $500,000. Today it's worth $3 million. During your retirement, you borrow $1 million against it using an SBLOC to fund your lifestyle. You pay interest along the way, but you never sold a single share. You pass away, the stock is now worth $3.2 million. Your heirs inherit it at the $3.2 million basis. The estate sells $1 million worth of stock to pay off the SBLOC. And because of the step up, there's essentially no capital gain on the sale. Your heirs keep the remaining $2.2 million of stock. And the $2.5 million gain you racked up during your lifetime, never taxed. Not by you, not by them. The Yale Budget Lab describes it this way in their 2025 analysis. All lifetime income taking the form of unrealized appreciation completely escapes taxation. Now, this strategy has been around for a long time. It's been the subject of many congressional debates over time. And at the same time, the OBBBA increased the estate tax exemption from $7 million to $15 million. And for a married couple, the exemption is $30 million. What this means in practicality is for the vast, vast majority of you, this provision won't be taken away by an estate tax in the future. This means the big downside of holding appreciated assets until death has largely gone away for most Americans. And the other thing that happened is that the OBBBA kept the current capital gains tax provisions in place, 0, 15%, and 20%. The 0% bracket matters more than you would think, and I'll come back to that in just a moment because I want to talk about one other provision here. The law also created a temporary $6,000 deduction for anyone who's 65 years or older, so a married couple filing jointly has a $12,000 deduction. That provision runs from 2025 through 2028 unless it's renewed, and it phases out at higher income levels. But here's the part that surprises most retirees. You don't need to be Warren Buffett to use a version of this strategy. In fact, there's a version where you don't have to borrow at all, because the 0% capital gains bracket is far more generous than most people realize. For a married couple filing jointly in 2026, up to about $96,700 in long-term capital gains and qualified dividend income can be taxed at 0%. That's the federal tax portion anyway. State taxes vary by state. That means a lot for retirees. The smart play may not be borrowing against your portfolio. It could be slowly harvesting gains during years when your taxable income is low, paying zero federal tax on those gains, and resetting your cost basis higher as you go. You get most of the tax benefit that the billionaires get, but without taking out a loan and paying interest on that loan. You also get to hold your most appreciated positions until death and then let your heirs get the stepped-up basis on those positions. Now, I want to spend just a minute or so talking about something that really doesn't get covered enough, and that's the risk. And there are real risks associated with this strategy. Risk number one is a margin call. If you borrow on your portfolio and the value of the portfolio drops below a certain threshold, the brokerage firm may ask you to put in more capital because you've exceeded the limit. If you don't have capital to put in, then they'll start selling your positions at a loss. And you really don't want them selling positions at the worst possible time. And to add insult to injury, you might have capital gains tax on those positions as they sell them because they may have sold them at a price higher than when you bought them, even if it's not at the peak price. In this scenario, the strategy that was supposed to help you avoid tax just triggered a big one. Risk two is interest rates. SBLOC loans are variable interest rate loans, which means that in a low interest rate environment, you pay less. In a high interest rate environment, you pay more. When SOFR, the overnight interest rate that we talked about earlier, was near zero, it was 2021. So the person executing this strategy might have paid 2%. Today, they're paying 5.5% or more. If interest rates continue to rise from here, so will the interest rate on your SBLOC loan. The third risk is that the law could change. The OBBBA was put in place in 2025, but that doesn't mean a future Congress can't put in place a different law. I would even say it's likely at some point in the future, maybe 5 years, 10 years, 20 years, who knows, but I would say that it's likely that there will be a different law put in place at some point. Risk four is that compounding interest eats your returns. Here's how the math works. If portfolios grow at 7% a year and you're paying 6% on the loan, your real after-tax gain is only about 1% on the borrowed portion. The strategy only wins, or clearly wins anyway, if your returns on your portfolio exceed the interest that you're paying to borrow from the portfolio. A portfolio that was rock solid for 10 years can drop 30% in a recession, and all of a sudden the interest payments look a lot worse than they did when the portfolio was 30% higher. And one last point that the Yale Budget Lab study showed, only about 1% of the top 0.1%'s income comes from this strategy, meaning they get 99% of their income from other sources, dividends, rental income, etc. The buy, borrow, die strategy gets a lot of attention in the press, including the ProPublica's reporting on how certain billionaires pay nearly zero effective tax rates. But it is a tool used at the margins, not a universal playbook. That's worth remembering. So the buy, borrow, die strategy has one core feature that is really important. It's the step up in basis. Everything else is interesting but not necessarily useful if the basis did not step up. The big takeaway here, and you don't need to be a billionaire to realize this, the account that you hold your assets in matters as much as the assets themselves in many cases. Speaking of planning, gang, if you're still using spreadsheets to manage your finances, you're doing it the old-fashioned way. The fact is, even a simple mistake in a single cell on a spreadsheet can mean that your entire plan is off, and what you thought was a success could become a failure very quickly. On this channel, we have 3 affiliate relationships. One is Bolden Personal Financial Planning Software. That's the personal financial planning software that I personally use. Bolden can help you model out a lot of different scenarios, including scenarios like we're talking about here, and more importantly, it can help you understand your probability of success. I like Bolden so much, in fact, that I was a user before we started representing them on this channel, and I contacted Bolden to ask if we could bring them on the channel as our affiliate. If you'd like to try Bolden free for 2 weeks, you can use our affiliate code. It's go.bolden.com/Schmidt. When you use that, you'll get 2 weeks free. After that, it's $12 a month paid annually. Gang, before you ever consider an SBLOC, talk to a CPA or a financial planner to make sure that this is a strategy for you. Because the question isn't whether you can borrow against your portfolio, but whether this strategy is the best strategy for you and your family, frankly. Most retirees find that simpler strategies provide most of the benefit, and they don't have to take the risks around borrowing against the portfolio. You just need to understand the rules that the wealthy have been using all along and apply the parts that fit your specific situation. If you like this video, check out that video, how a retired couple can pay zero taxes on $100,000 of income. Also, don't forget to check out Bolden at go.bolden.com/Schmidt to get your 2 weeks for free. This is Jeff Schmidt, and I will see you in that video right there.